A higher for longer rate scenario voiced by US Fed Chair Jerome Powell pressures stocks, financials and energy lead the decline while FMCG ekes out gains.
The Supreme Court extends the stay on long-awaited open offer to Fortis Healthcare by shareholders by IHH. The move dashes hopes and dents the stock.
Triveni Turbine and Dodla Dairy gain after notable investors check-in, while SpiceJet sulks after the DGCA extends a cap on its flights, even as sources suggest it may hike staff salaries.
The rupee breaks the 80 per dollar barrier as the RBI lets go. All Asian currencies are down half to 1 percentage point as the Fed shocks with a guidance of 150 basis points more of rate hikes.
Good afternoon. Welcome to Halftime Report. I'm Sonia Shenoy and with me is Ekta Batra and Mangalam Malu. Well, not too bad really. It's down but not out, you'd have to say. So 17,550 is where we're at. If you see the intraday chart of the market, it may and there are multiple rate hikes that could come from not just the Fed, from the RBI, but many other central banks across the world. And I guess that is having an overhang on the market. But overall, you'd have to say levels are being protected despite all the the volatility. Yeah.
Yes, absolutely, Sonia. And, we do have an RBI policy next Friday as well, so we need to prepare for that. Based on the hawkishness that we've seen from central banks globally, we can expect the RBI to probably step on in terms of rate hikes for our markets as well. But as of now, the Bank Nifty down around 1.5%, the mid-cap index down around 1% at this point in time. And it is definitely a red screen that we have with only 11 stocks within the Nifty space which are gaining at this point. Hi, Mangla.
Hi. Last week on Friday, the low on the Nifty was 17,497. And then on Monday, before we started rallying, the low was 17,430. So that's telling you that the street believes that 17,450 to 17,500 could be a strong support zone for our market. So let's see where we go from here. Currently, we're down almost 163 odd points, understandably, because of the weakness that we're seeing in the global markets. But talking about global markets itself, let's get chatting with the first management that we've lined up for you on the show today. Is the manufacturer and exporter of knitted garments. We have SP Apparels in focus. 88% of the company's first quarter revenue, remember, came in from garment exports. And with the rupee weakening, how is it set to benefit the company? And we also have the festive season. So a whole host of things basically to talk about with Mr. P. Sundaraman. Thanks a lot, sir, for joining in. Can you tell us, one, how much does your revenue come from the US? How much of it is from Europe? And with the weakness that we are seeing in both these economies, what is the outlook for this year? Do you still hold that 15 to 20% revenue growth guidance?
Yeah, yes, definitely we are always trying to maintain this 15 to 20% growth, which is always happening. We don't see any issue in this one going forward. And as such, our American business is about 10 to 15%. And the UK business is about 40%, and the remaining is about 50 to 55% will be the rest of the world, which means the European market, etc. And the growth is yes. So this is the plan. This is how we are working towards.
Okay. So what are you seeing in terms of the overall demand trends? You have across the board, there's been an improvement in your garment division, but just want to understand that what are the trends looking like now in terms of both exports and domestic, and what are you targeting over the next couple of years?
Yes, as of now, there is a big recession in Western countries. The post-COVID, definitely there is a big recession and inflation is happening. So the priority of spending on clothing is coming down. However, since we are in the niche segment of babies and kids wear, I always used to say that there is always a perennial demand for this segment. And we currently have the current order book of close to 400 crores, which is up to the month of January, February. So which means we are comfortable for next 5 months. And in spite of this fluctuating, the currency of pound and euro, still we are playing very safe. With regard to the US dollar, it is definitely advantageous to us. So anything we are yet to book, we will definitely take the advantage of it. And going forward, definitely we look at FTA is on the way. Any moment expected. If FTA comes, already the importing countries in Western countries are anti-China, and slowly there are some reluctance in even buying from Bangladesh. So they would be waiting for FTA to happen. So the business to India will inflow will be very high. So we are looking forward to that one.
Okay. Mr. Sundarajan, you've said that you have an order book of around 400 crores. So you have visibility for around 5 months. But are you seeing any signs of concern at all in terms of the order book, and hence maybe you would reconsider your business model, say concentrating on other geographies, or maybe looking at the Indian domestic market, considering the kind of demand we're seeing here?
Yes, definitely now we are looking at the other markets like Australia, etc., and other rest of the European countries, and even we are looking at the business in Russia. So we are looking at other demography also. For the plan, our plan will be for the second year from now. So that is one thing. And the domestic market is really doing very good. So our domestic business, although it's in our overall business about 10-15% of the total business, still we have a very aggressive, ambitious plans for the next 3 years to grow the business in the retail, in the domestic retail. Maybe we expect at least double the business in the next 3 years' time.
Can you tell us how much of your forex exposure is hedged and how much of that stands to benefit with regards to the weakening in the rupee that we're seeing?
So we strictly adhere to our forex policy, where in anticipation when the inquiry starts we book 20%, and when the order inflows come we will book 40%, and during the process of shipment another 20, and keep 20% always open, which may due to changes in the deliveries or shipment quantities, etc. So any given time we always have 20% open. So in that 20% we can take some advantages of US dollars.
Does that mean with 20% being open and you getting the benefit of that, raw material prices cooling off from the top, your margins can expand beyond the 18% that you've guided for?
See, I cannot promise anything. We always maintain 18 to 20%. But currently because of the sudden increase in the cotton price, but that has affected the entire industry. So there could be in this quarter there could be 1 or 2% slightly lesser, which we are trying to manage. Even with the excess shipments, like. So we can maintain 18 to 20% at all time. That's for sure.
So just to clarify, this revenue growth target 15 to 20% that you had laid out for FY23, you hold on to it despite all that's happening across Europe, right?
Yes, correct.
Okay, all right. And on the buyback, I wanted to understand what's the latest. Are the promoters looking to participate?
Yes, we are, as a promoter, we are also participating in this buyback.
Okay. All right. Just a quick last question, Mr. Sundarajan. Would you look to probably diversify your existing order book in terms, you said geographies, you said, possibly the domestic market as well. But right now, you're solely concentrated on children's wear. Do you think that there's a market beyond that? You would look to diversify into other segments? And if so, what? And any details you could lay out for us?
Yeah, it's a good question. See, yes, our existing customers, they are trying to consolidate their business to the limited factories. So if that's the case, some of the customers already are consolidated enough in the kids and babies. So now they are asking us to take some business of men's and ladies, which are not a big challenge for us, because we are strong in babies and kids, which are the more complex products. So we are planning to take some business of men's and ladies as well as a portion. So gradually we'll also increase that for the future growth.
In the first quarter you did volumes of almost 15 million units. All of last year you had done 50 million. So wanted to know how many pieces can you sell this year? That's one. And secondly, on your India business, the retail business that is, you have said in your conference call that you will list it at an appropriate time. Can you define what the appropriate time would be? I mean, at what level of stores, at what level of revenues, and how far down are we?
a platter of so many products, maybe a product of 40 rupees and the product of 200 rupees. So it all depends. So the quantum will not give any idea about the growth. That's why I say that we can definitely do 15 to 20% growth year on year. No matter. See, sometimes we do more of pajamas, sometimes we may do more of small products of babies. So that's not the right yardstick to measure the growth. So with regard to the retail one, yes, now the retail business is doing extremely well, and especially our retail division is doing very good. Crocodile is there, and we are also into the children's international brand. London brand is called Angel and Rocket one, and also we have Head is the skiing and the tennis brand. It's an international one. So we have India license for the clothing as well as for the footwear one. So we are working towards it. Until it reaches a maturity, it may take another about 2 years' time. So once we get this maturity, then we will be looking for getting them listed in the retail division.
Okay, all right. So thanks a lot for joining in, and all the best with your future ventures. That's SP Apparels. It's had a decent run. Actually, in the last 3 months, the stock has gone up about 20-odd%. And they stick to their guidance of a 15 to 20% revenue growth for the full year, despite all the challenges that they're seeing in Europe, where they get a large chunk of their business from. Let's slip into a short break. Up next, Prashant will be here to give us the key takeaways from the FOMC meeting. Remember, the Fed hiked rates by 75 basis points, third straight rate hike in a row. More on that in a bit.
Welcome back. Well, the big global development has been the US Fed, which has hiked rates by 75 basis points for the third consecutive time. Prashant is here. He's standing by with the 10 key takeaways from the FOMC meet overnight. Prashant.
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant on the FOMC committee is looking for another 125 basis points of hikes in the remaining 2 meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another 2 hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number five, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number six, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number seven, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number 9, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time, and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very, and this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined 3 conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, to summarize, I would say that this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
Oh, absolutely, and that's what's taking place right now. Most markets are under pressure, including our own, which is at the lowest point of trade. Let's slip into a quick break. On the other side, Sudeep Shah of SBI Securities will be joining in. He'll have some trading strategies to share with us. Do stay tuned in.
Welcome back. We are seeing some pickup in a couple of these cement names. So India Cements is now sitting with a bit of a gain, and alongside that, pharmaceutical companies and FMCG, they've been doing well all through the race trading session. Dr. Reddy's is at the high point of trade. Let's get in. Sudeep Shah of SBI Securities joining us for his view on the markets and individual stocks. Sudeep, we've bounced back from levels closer to that 17,500 mark couple of times in the past few days. Do you think that will hold on today as well?
Absolutely, Mangalam. Good afternoon. One thing what we can see today is also that in the last few days and today that there are a lot of dips that have come to 17,380, 17,450 kind of mark. But a lot of these dips have been bought into. And that was because the Bank Nifty was showing higher strength. Now, since because of the dollar index moving above 111.5 and USD INR crossing this 80.70 mark, Bank Nifty is witnessing some selling pressure. But today, Pharma as well as FMCG has picked up to support Nifty. So we feel that this time around also 17,400 kind of support zones should hold. And only if this is broken, we need to revisit our levels. Till then, we feel that the markets would be in a range between 17,380 on the downside and 17,750 on the upside.
In terms of individual stocks, I wanted to first ask you about Infosys because the stock has been hitting new lows. It's at a fresh 52-week low today. At any point in time, does it become a buy? And what do you do with the other names in the IT space?
See, more than the large cap names, now if we specifically talk about Infosys and TCS, they have already broken their intermediate swing lows, and there is still no signs of any reversal that we are witnessing on these large cap names. But a couple of stocks like, say, if you say a mid cap name like KPIT or from the mid cap IT space, now there we are seeing some action. We are even seeing some kind of a bottom fishing happening in Coforge. Now, specifically talking about KPIT also, it has been forming a rounding bottom after a big consolidation now. And that is the best chart amongst all the mid cap IT names. So we feel that there is a good upside potential here, and this stock can be bought with a 600 stop loss for an upside move up to 700 levels.
Okay. You were talking about the resilience of a lot of these pharmaceutical stocks, Sudeep, but within the healthcare space, Fortis is reacting to a significant amount of negative news. How would you technically advise your clients to approach the stock now?
See, today's candle, now if we see today's selling pressure that has come, it's almost 16% down post this court judgment. So we feel that should not be entering at current levels. At least let these news gets digested, and the chart looks to be weaker for us, and we feel that this stock can head towards 230 to 20. So a lot of good opportunities are available, whether we say in the pharma space also or in the FMCG space. Now, last few days within the pharma stocks also, there was one stock, Cipla, which was making a move, breaking out. Last couple of days, we have seen some throwback on that, but it is still trading above its support level. So Cipla from the pharma space, HUL from the FMCG space, both looks very good. And pharma as well as FMCG now may start performing from here on to support the Nifty if we see further weakness in banking stocks.
Okay, all right. Sudeep, thanks a lot for joining in. Have a good day. That is the word coming in from SBI Securities. But let's get you some market opinions since such a large event has now come and gone, the US Fed meet. What do you do with the market? Sunil Kaul, who is the equity strategist at Goldman Sachs, gives us his opinion on the Fed's guidance. He also talks about how he recently downgraded the IT sector in India and continues to believe that there are deep challenges that lie there, both on the revenue as well as on the margin side. Listen in.
The 75 basis points hike which we saw was in line with our expectation. The guidance obviously was a little bit much more hawkish, both in terms of the dot plots, but also in terms of the press conference later. And so we were actually looking at the Fed terminal rate of 4 to 4.25 range, and obviously the target rate was 50 basis points higher. So as a consequence of that, we also just changed our rate forecast. So we are now looking at a similar target Fed fund rate at 4.5475. So India kind of checks that box where it's one of the domestically demand-oriented markets, somewhat more defensive, but I would still point the fact that valuations in the market are a little bit more extreme or on the higher side, at least in terms of premium to the region. And so our base case here is that markets consolidate, at least on the next 3 to 6 months. IT, we actually did downgrade the sector pretty recently, and so thought was basically, look, the market is still optimistic in terms of the US dollar revenue growth in there, looking at double-digit growth. So we think the top lines will slow down to sort of a mid-single-digit 5-6% growth, whereas valuations still are on elevated side around sort of 23-24 times for the sector as a whole. So to us, looks like the valuations are still not factoring in the potential down cycle you can see in the tech sector. Obviously, I know that the sector has underperformed, but we still think there is more to go in here. If you look at the EM funds, what's interesting is that we have actually been seeing outflows from the EM active funds for a while. In fact, year to date, the EM active funds have actually seen close to $20-25 billion of net outflows. What has been holding up the flows is ETFs, EM ETFs, and the fact that India, because of its outperformance, its weight is also increasing, and then it's acting as a hedge to China, means that flows into India via the passive route have been increasing. But interestingly, if you sort of look at the past 3-4 weeks, we're also seeing a slowdown in the ETF flows.
Okay, time for a short break. But up next, we'll be discussing possibly what is the stock of the day. Fortis, the Supreme Court decision on Fortis Healthcare. We shall be connecting with J.N. Gupta to get his perspective on the inordinate delay that shareholders have seen in the open offer. He's a former ED at SEBI. Stay tuned. Welcome back. Well, for the markets, the Bank Nifty is trending a little bit lower. So currently down close to around 2% for the Bank Nifty, not turning out to be a great day for these rate sensitives. HUL is your top gainer along with ITC. So the FMCG pack seems to be bucking the trend at this point in time, along with Eicher Motors, which is building on its gain of over 40% on a year-to-date basis. So Eicher Motors too up around 1.5%. But let's concentrate on the aviation space. SpiceJet is in focus and under pressure. This is after the DGCA extended its cap on its flights. Sources suggest that the company may hike staff salaries. That could possibly be a reprieve in terms of operations. Sonia, tell us more.
So, the reason why the stock is down today is because, as you said, the DGCA has now extended its flight cap. So the DGCA has told SpiceJet that they can operate only 50% of their approved flights till October 29th, and that's because of enhanced surveillance. Now they're losing out on a lot of business. This is at a time when there's such a big recovery, such a big travel boom. So other players will obviously benefit from this cap that the DGCA has put on SpiceJet's flight. Now the SpiceJet carrier has been facing acute liquidity crunch, as we know. It's been on for a while. They sent 80 pilots on leave without pay for 3 months as a temporary measure to cut costs. And there is no recapitalization plan in place. But sources also suggest that SpiceJet has now announced a 20% salary hike for pilots from October. This follows a 6% hike in salaries last month, and a significant portion of their Provident Fund, PF, will also be credited. Now, this is very confusing because on one hand, they've asked 80 pilots to go on leave without pay to bring down costs. On the other hand, they're saying that, they've announced a 20% salary hike for the other pilots. So this seems to be a bit of like a damage control move. Overall, it's still very, very crunched on the balance sheet. And I think that just the fact that the DGCA has asked them that they can only fly 50% of their capacity for the next 1 month till October 29th is a big negative, because, there is a big travel boom and they just can't, take advantage of that.
Take that point, and that's reflected in the way the stock has corrected from the peak as well, and now down another 4% in today's trading session. But the one which is doing well is Apparels Housing, and that's primarily on account of a city initiation on that stock with a high target price as well. The stock sitting with a gain of almost 5%. Abhishek joins in with the details on the same. Abhishek.
Well, as you mentioned, Citi has initiated coverage on Aptus Value Housing. They have a buy recommendation and a target price of 425 per share. They say that this is a player with a high profitable, affordable housing lender. So they have demonstrated quality underwriting, given the fact that their credit cost has been below 20 basis points in pre-COVID levels. And even at COVID time, they had a peak credit cost of just 86 basis points. So good execution should see a CAGR in terms of loan growth of around 29% over FY22 to 24, and pricing power and efficiency in cost structure will help to boost ROA of Aptus Value Housing. So they are building a 60 basis point decline in net interest margin over FY22 to 24, given the fact that share of home loans as well as leverage will play out in reducing the net interest margin. They expect ROA of 7.4% and ROE of 16.5% in FY24. So in core geographies, they are quite under-penetrated. So Citi does expect, there is scope for growth. And also, given the fact that, Aptus Value can reach out to other geographies as well. So there is good scope for loan growth going ahead. Back to you.
Okay, thanks a lot for that, Abhishek. Well, let's move on to some management commentary then. Earlier today, we got chatting with Pralay Mondal. He's been appointed as the Managing Director and Chief Executive Officer of CSB Bank for a period of 3 years starting 15 September. So let's listen into what he had to say specifically about the gold loan business of CSB Bank. That has been under pressure, so there's a bit of a recovery that they're seeing now. More on that from the management.
The way we are planning things out is, yes, we will grow faster than the ecosystem. And the credit growth in the industry is around 15-16%, and I think it will remain there. And we think we should outpace that in the next 2 to 3 years, including this year. I think we are looking at growing much faster than what we have done in the past. The second part is how do we do that? Of course, we'll build the retail engine a lot more. That takes 12 to 18 months to build, because you need to create a lot of systems, processes, technology. We do understand that gold loan is a relatively larger component of our asset book, but that's not how it will stay over the next decade or so in the bank, because what we're doing in the bank is looking at a much longer term perspective. How do we want to build the bank? And there we will have gold as one of the key levers of growth in the next few years. But the larger growth will come from retail, SME, and then also wholesale by the end of this decade. I have done retail all my life, so let me tell you that the retail book which we have is a vintage portfolio that's just running off. So don't read too much into what is happening in terms of negative growth, because that's running off. What is more important is looking at the future, what you're trying to build. And that's where we are going to have all products and services in the bank, some directly within the bank, some through partnerships.
All right, so that's about CSB Bank. Meanwhile, just keep an eye out on a couple of these broader market names which are actually doing well in an otherwise weak market. We have Newland Labs, which is up 15% in today's trading session. Barbecue Nation and Westlife Development, both these QSRs too, doing well. Westlife Development has recovered about 2% from the lows, and Barbecue Nation has moved to the high point of trade. With that, we slip into a short break. But before we do that, here's something that is great news for you investors. You can now track the US market actions real time on moneycontrol.com. Log on to the Money Control website or the app and stay informed about all that matters in the global markets, more so in the US markets.
Pressure down 17%. This, of course, was the big overhang for a while, and now that the stay has been extended, it's just, caught the stock off guard.
Yes, absolutely, Sonia. I think, the street was going in with a lot of optimism with regards to what could happen today, because they didn't really see any reason for another delay to take place after December 2018. So the news, yes, is that, and as Ashmit had told us earlier, that the Supreme Court has pronounced a stay on the IHH open offer. They've directed the Delhi High Court, in fact, to consider forensic auditor when it comes to the appointment for the IHH deal. And now that it's in the Delhi High Court's, it's the Delhi High Court's issue with regards to what they do with the open offer going forward. So I just want to point out that this delay has brought up a couple of questions. First, what does it mean for IHH as a whole? Fortis management has said that IHH is committed to Fortis. We've heard Dr. Raghuvanshi tell us on the channel itself that there is a commitment from IHH. Analysts, however, point out that now concerns on IHH stake could possibly come up because of the forensic audit as well as the uncertainty over the open offer, which has continued since December 2018, and Fortis could possibly be an M&A candidate. Secondly, for shareholders, what does it mean? There is a delay in the open offer since close to 4 years for shareholders. Remember that this delay or the Supreme Court stay came 4 days before the 3,350-odd crore open offer deal was expected to begin. Now, SEBI too had made an urge to the, had urged the courts in 2020 to allow the open offer to go ahead, but it obviously didn't happen. And experts say that, however, the open offer needs to be put into context. The validity of the deal itself is now in question. Hence, the open offer does not take precedence in such a case. Lastly, what about the Fortis stock and the overall operations? If you just look at the performance of the Fortis stock, it was at a 52-week high just last week. It has corrected, and if you, take out, if you sort of just look at the 52-week high and the open offer price, the stock has already given in returns of around 90-odd% from that point. The Q1 FY23 numbers are very strong for the company. Elective surgical revenue was 61% of revenue for hospitals. It was an all-time high. Q1 FY23 margins were at 17%. Occupancy at 65%, expected to improve to 70%, and international patients revenue was up 126%. So it's really firing on all cylinders when it comes, possibly not for the diagnostic business, but when it comes to the hospital business for Fortis. But that could possibly be one cushion for the stock. However, to discuss the fact that the open offer, in fact, has been delayed now for close to 4 years. What does it mean for shareholders? J.N. Gupta, the former ED of SEBI, joins in to discuss this and this perspective of the case. Mr. Gupta, hi. Thanks very much for joining in. Well, we've been discussing this since 2018, and I wanted your perspective now. What does it mean for shareholders? Because now it's close to 4 years, and they still haven't got that promised open offer.
See, to be very fair and frank, open offer at this stage is insignificant or of no value, because open offer price was supposed to be 170 rupees and already the share was trading for 300 plus. So I don't think there was any shareholder who would be waiting for selling its shares at 170 rupees to IHH and not selling in the market. It is only for now an academic interest. Now, there are a couple of aspects of the total thing. First thing is this: what happens if entire deal is cancelled? If IH's buy of shares is cancelled, to me, it is a situation, I don't think there is any possibility, because for 4 years and plus, IHS has been sitting in the management of Fortis, and they would have done transactions, because if the turnover of the company is to be taken, so they would have done transaction of 10,000 plus crores in last 4 years. Now, you can't reverse those transactions. You can't go back in time. So the issue is very simply today, as far as the shareholders are concerned, there are two aspects. One, I have already said, 170 rupees price is insignificant now because it was 300 plus, so nobody would be waiting for this. The second is a very important issue, from where the shareholders' rights emanate. The shareholder rights emanate from the fact that there was a deal. If there is no deal there, then there is no right emanating to the shareholder. Now, the most important thing is this, that we must focus on this, or rather Supreme Court or the judiciary must focus, that in cases like this, where a deal has got 100 legs attached and so many stakeholders are impacted, can there be delay of 4 or 5 years? Now, even after 4 years, you don't know what is going to happen, because forensic auditor will be appointed, then their report will come, and then again case will drag for I don't know how many years. So in a commercial transactions where there are multiple stakeholders, there is no one-to-one crime, or there is no one-to-one cheating. This is a very important thing. And if you look at the entire background, the entire thing emanated from a transaction that happened at Singapore level, where some sort of a preference share, or I don't remember now, all the transactions happened, the Singh brothers benefited from the transaction. Now, after 4 years saying that everything is wrong, we must now go back and find out what was the auditor doing, what auditors had done, and what the bankers had done. Because it is an issue where the whole system is a trouble. The people will lose confidence in the system if after 4 years some deal is cancelled.
So from a shareholder standpoint, you did mention about what the way forward could look like. I'm trying to understand that what about IHH's commitment to, CAPEX, the expansion plans? What happens to all of that?
See, I tell you, IHH is in a very difficult position. After putting so many crores or thousands of crores in the system, now they have no option but to say that I am committed because I have spent my 4,000, 5,000 crore into the deal. So it is not a thing that I will not be committed. The problem is, what if IHS deal is set aside? Then what is going to happen to this, and where this shares will go, and whether Daiichi will be the owner of those shares, we do not know. So all this thing is in a very gray area, but two things are very clear. As far as retail investors or shareholders are concerned, they already had 4-year time to exit at a much better price. That was the open offer price. So there is no cribbing from that side. The second and most important thing is a systemic issue, that all such cases cannot take 4 years or 5 years to be decided, because it impacts. Because there is no way you can put Fortis back to 4-year back position before IHS came. IHS has taken. Now, tomorrow there will be an issue after something, that now you got to examine what IHS did in 4 years. It's opening a can of worms.
Right. Thanks, Mr. Gupta, for joining in. Points well made and taken on board as well. We hope that, the points that you've made will perhaps at some point, at least in prospective deals, be noted as well. And, it won't take as long for these resolutions. With that, we step into a short break. Shift focus away from the equity markets. On the other side, Manisha Gupta joins in with Kunal Shah of Nirmal Bang Commodities.
Welcome back, and it's a choppy commodity markets when you look at that, and even as most markets were anticipating a 75 basis rate hike, and that's exactly what we have seen. What the markets weren't prepared for is even more aggressive rate hikes going into November and December, and that's exactly the kind of reaction that we finally have started to see into the markets. As you can see, the gold price is now down $15 from the kind of closing that we saw in the markets yesterday, even as there has been some support for gold because the Russian president has talked about mobilizing more troops in Ukraine, and that perhaps could have been a supportive factor. But the market's now digesting the fact that we are looking at more aggressive rate hikes going forward, and that could really be impacting many of these commodities and currencies as well. We already are dealing with the rupee, which is trading at a record lows, and is the reason that even as the international markets have declined quite sharply, there is a bit of a cushioning that you have seen come in for the Indian markets because of that rupee calculations. So as much as losses that you are seeing for the US dollar, the other currencies perhaps are not there yet. There's a report on Citi that's on your screens right now which suggests that we could be looking at further declines in case of gold. A giveaway in sense of $1,650 on the lower side could open doors for $1,600 per ounce as well on the lower side in case of gold. That's what we are seeing for silver as well. Prices have continued to decline, $19 per ounce, just about holding there. And the base metal prices, even as they're not doing so great in the international markets, because you have seen weak data, the US home sales numbers have declined for a 7th straight month for August. We also are looking at weaker numbers when it comes to the Chinese industrial data. There's a report from Rio Tinto suggesting that the inflation and supply chain disruptions will weigh onto the market, and the copper inventories have gained the most since the month of June. So the last 1 week actually hasn't seen much of on-ground demand as well come in for the metals. That continues to weigh onto this level. Going forward in 2024-2025 is where the banks and brokerages are expecting the demand to start picking up. Until then, there could be a choppiness. Markets will continue to react to every rate hike or every monetary policy that we see there. Let's get in then. Kunal Shah of Nirmal Bang to get a sense on how you should be trading many of those commodities now. Kunal, hi. First up with metals, and even as the global markets are kind of steady or consolidating, Indian markets reacting to the depreciating rupee. But how would your trading strategy be from here on?
Well, I think it's a set and rise market for commodities. The way Federal Reserve has clearly indicated, their stance going forward is going to be very hawkish, and that's not a good news for commodities. The only thing which is going to prevent the sharp depreciation is that the Federal Reserve refused to sell the mortgage-backed securities. So they were supposed to sell $35 billion worth securities into the market. So that means that the liquidity conditions are not going to get tighter immediately, and hence we are not going to see a sharp capitulation. Apart from the US, the scenario in China is more scary right now. The way the slowdown is spreading. So even though China is coming up with a lot of stimulus packages, they are following the easy monetary policy, but I think they are not going to get the same amount of result out of these policies. So it's not a good news for commodities as the demand growth continues to slow down in the Western world. The demand growth continues to slow down in China. So we are not going to see any major bullish trend in commodities, at least for the next 3 to 5 months.
Kunal, what's your sense on gold prices? Because while yesterday, we didn't even see a knee-jerk reaction come in for gold, but that seems to be coming now, $15 down on the screen.
For gold, it's getting more clearer because in near term, it may not move up. The reason for that is, so if I'm a money manager at US and I'm getting 4.5%, 5% in US banks, why would I invest in money? And that's the reason why there is a major redemption going on in gold ETFs. So there is a constant redemption from last 2.5, 3 months in gold ETFs, and hence gold futures are coming down. So in near term, gold may not be able to perform. It can test levels of 1650 to 1630 on the downside maximum. But as and when the job market, like Fed yesterday said, they are expecting job market to weaken going forward. The housing market also to show some weakness going forward. So the moment the fear factor arises, at that time gold will shoot up abruptly. So in near term, I think gold may not move significantly up, but from the 2 to 3 months horizon, I think there will be a bottom place for gold. And I am bullish for the year 2023 for the outlook of gold.
Kunal, we'll talk to you about the rupee as well, because we seem to be making newer lows onto this 180.80 on the screen right now. Surprisingly, there's no RBI intervention. Markets were anticipating that. But clearly, when you look at the other Asian currencies in last 1 month, rupee's decline has perhaps been the least. But from here on, what is the sense now?
Okay, so now everyone is, most of the currencies, so our neighbors, each and every currency, China, if you look at every currency is weakening, and it seems that the dollar index is also going to strengthen further. So it makes sense for our central banks to wait and then intervene rather than immediately intervening, because I think the dollar index is clearly going to move up from here. I'm expecting dollar index to test levels of 114 in perhaps 2 to 3 weeks going forward from here. So when the dollar index is going to strengthen, I think there is further depreciation left for rupee, and I'm expecting, you know, Indian rupee to test levels of 81.50 to 81.80 going forward, and perhaps those would be a better level to do intervention rather than right now. So that's the reason why, in spite of 1% depreciation today, we are not seeing any intervention, any signs of intervention by the central bank, and I think the rupee is going to depreciate further. Till the RBI meeting, we are going to see some more depreciation in the store.
All right, biggest one-day decline in last 7 months and still declining in case of the rupee. But that clearly is the way that we are looking at some cushioning when it comes to the Indian commodity prices there. Kunal, thank you so much for joining us with your sense on currencies and commodities. With that, out of time on the show, Business Lunch will take all the action forward.